What if the biggest investing edge isn't picking one stock, but knowing which sector money is moving into next? Sector rotation is when investors shift money from one part of the market to another as the economy changes. The idea is simple. Different sectors tend to perform better in different phases of the business cycle. As growth, inflation, interest rates, and consumer demand change, some businesses benefit more than others. That's why leadership in the market often shifts instead of staying in one sector forever. In the early part of a recovery, more economically sensitive areas have often done well. Fidelity notes that sectors like financials and consumer discretionary have historically tended to benefit as growth improves and conditions become more supportive. As the economy matures, leadership can broaden or shift again. Investors watch for changes in earnings strength, spending trends, inflation pressure, and rate policy to judge whether leadership is staying cyclical or starting to become more defensive. When growth weakens or recession risk rises, investors often look harder at more defensive parts of the market. The reason is simple. Some businesses are less tied to the economic cycle than others. Here's the catch. Sector rotation sounds simple, but timing it is hard. Even Investopedia points out that the market often moves ahead of the economic data, which means investors can be early, late, or completely wrong. Investors often monitor business cycle trends, sector performance, earnings expectations, and relative strength tools. One example is the relative rotation graph, which compares sectors by relative strength and momentum. If the economy looks like it's recovering, an investor may lean towards sectors that historically respond well to improving growth. If the economy looks like it's slowing, that same investor might reduce cyclical exposure and move toward more defensive areas. Sector rotation is really about one question: where is the economy now, and which sectors are most likely to benefit next? Get that right, and you may improve positioning. Get it wrong, and rotation can hurt returns. Subscribe to PEB Capital for simple breakdowns on how money moves, how markets work, and how investors build smarter strategies.